Hey, Renter Retires, it's Adam Schroeder here with another episode, joined as usual by Zach Lemaster, the founder and CEO of Renter Retirement. And we are pleased to be joined today by Jeff Welgan. He is the VP of Investor Lending with BluPrint Loans. Jeff, thanks for joining us.
Yeah, thanks for having me on. It's an honor. Appreciate it.
Yeah, so there's a lot of lending out there, a lot of choices, everybody knows. Y'all have, but a lot of those lenders have only been around a few years, don't really, focused maybe on primary homes only. Tell us a little bit about kind of your timeline in the mortgage world, kind of what BluPrint is in general before we hop into the real meat and potatoes.
Yeah, well, it's a great place to a great jumping off point for this. So, just give you a little bit of the background. I've been doing this for 21 years, and I've spent the last 10 years building a team dedicated to solving problems for real estate investors. And so we're a nationwide direct lender, and we lend everywhere at the moment except for New York. So we're in 49 states. We're a direct lender. Everything's done in-house with us. So we're not brokering these loans to anybody. And we sell loans directly to Fannie, Freddie, and Ginnie for all of the government products, like FHA loans, VA loans, any type of primary residence financing, second home financing, and investment products that are offered by the government. And then we also have 14 different relationships set up on the secondary market for non-conventional financing. And so we do the DSCR loan in-house, we do the business bank statement loan in-house, and we also do the asset qualifier loan in-house. We also have financing for our clients that are looking to do flips and the BRRRR method. So we do bridge financing as well. We're 1 to 10 unit only residential, and we don't do any type of true commercial or ground up construction at the moment. But we do have people that we trust that we refer out to if anybody has any questions there or needs a referral. That gives you kind of a quick rundown of our coverage and our product mix. And then what we specialize in is strategic planning for real estate investors. And our focus is helping our clients build and scale their real estate businesses as efficiently as possible, and really just try to take the guesswork out of scaling your real estate portfolio. And we're there for you every step of the way. So we do a lot of annual planning with our clients. We get out ahead of tax time and make sure that you've got a good plan going into tax time every year. And then we check in on a quarterly basis with our clients to make sure that they're on track to meet their goals for the upcoming year.
So you mentioned a word that we haven't really dove into much that I think can make a difference for investors. You say you're a direct lender. Tell people a little bit about what that means and how it might benefit them.
Yeah, it's a great question. So one of the primary problems that we solve for real estate investors is when you work with a lot of lenders throughout the United States, they may only have certain areas that they cover. It may only be in the South or in a couple of states, or they may have a very limited product mix where they do DSCR loans and fix and flip loans, but they don't have the government licensing to do, Fannie Mae and Freddie Mac loans, for instance. And so what we do here is, with the programs that we have that full coverage where a lot of lenders may only offer you what they have in their product mix, and they may not be able to give you all of the options that would be in your best interest. And so, again, one of the many problems that we solve for investors is being able to do this at scale with the full product mix in almost 50 states. We're going to be there in about another year with New York. It's about a 5-year process up there, and we've got about a year left. So,
shocking. New York takes longer than anywhere else.
Yeah, they don't make it easy.
Well, there's a reason we have you on here, Jeff, and that's because you have already been a exceptional resource to our investors, and I know we'll continue to be. Not only are you guys well known in the Bigger Pockets community, which we work very intricately with. I mean, I know you do a lot of lending for Bigger Pockets community, but also like the leadership at Bigger Pockets and some of the podcast hosts and things like that. So we were able to connect, I think, through that, but that just shows that BluPrint Mortgage, you guys are very investor focused. I mean, one thing we always talk about here, Rent Retirement, is like building your dream team, right? You really, when you're building a real estate portfolio, you're building a business, and you need to have all the key people in place that are going to help you be successful. That ideally know real estate, that take time to actually understand your goals, help you build out a strategy and execute that strategy, and have a diversity of options. Like on the lending side, as you mentioned, that's key to be successful because you truly are building a business, and you want to have people that understand what you're trying to accomplish and will spend the time to learn. That's so crucial with lending. I mean, I found myself often, every single property I buy, which is a lot every single year, because we do what we talk about here. We walk the walk, we invest. I love the tax benefits. If anyone listens, like lending, I always find myself interviewing a ton of different lenders every time I buy any property, just to make sure I have the right lending options. And to your point, like there's always different options that different lenders have. So having a dedicated lending team that is competitive on the loan terms and fees, that is investor savvy, that's crucial, right? Actually being able to get on the phone with you, help you map out a strategy and plan that offers all different loan options, the entire gamut and spectrum of lending. That way, if you're not just trying to fit round peg into a square hole or whatever it is, right? Like you actually can direct the person to use the option that's best for them. I mean, those are essential things. And so I really look at you guys as being kind of this one-stop shop for lending, where you can help all investors, regardless of their experience level, regardless if they're self-employed or they're W-2, and you're competitive on the fee structure, the interest rate and fees, which is seemingly the first thing everyone asks about, right? It's like, oh, what's the fees? What's the interest rate? And it's like, yes, that's important, but that's only one piece of the big picture here. So anyways, I know I went on a little tangent giving you guys my opinion, but we've really enjoyed working with you. We've had a lot of investors that have used you guys, and the feedback has been very positive, mainly around the time you spend with them to build a strategy. So let's talk about that just briefly. I would like to hear your opinion on like how are you guys actually different from the thousands of other lenders out there? How do you specifically work with investors to help them reach their goals?
Yeah, no, it's a great question. And to add to that, being that we are a direct lender, you mentioned the keeping the rates and the costs low. So we have a servicing department. And so that's one of the benefits of being a direct lender, is that we're actually lending our own money, and then we're securitizing and selling these loans on the secondary market. So when you go to, work with a broker, that broker is a middleman that is taking your loan package and giving your information to another lender like us that's processing the loan and collecting a fee for being that middleman. With us, everything, again, is done in-house. We're able to securitize and sell these loans on the secondary market directly to the GSEs, Fannie, Freddie, or Ginnie, or onto the secondary market on the non-conventional side. And we make money on the sale of those loans, along with the servicing of the majority of our loans. And then we pass that savings along to our clients. So that's the way we're able to partner up with organizations like you guys, great organizations, and then also keep the cost very low to our clients and stay very competitive and still be able to compete with a broker that may not quite have the overhead that we do.
So you mentioned the quarterly check-ins. Like, what does that look like? I mean, why would I want to get on no offense, but why would I want to get on the phone with the lender 4 times a year?
Yeah, just a quick check-in to make sure that you're on track. So we do annual financial reviews, which we're doing right now, going into tax time. And really, when you are going to see your accountant, everybody, whether you're, a business owner or a real estate investor or just starting out, your accountant's always going to look at it from the perspective of trying to maximize your refund or minimize your tax liability, which doesn't always put us as business owners and real estate investors into the best position to qualify for our goals for the upcoming year. So what we do is in Q1, we reach out to all of our clients, we schedule calls, and we sit down and discuss our clients' goals for the upcoming year, and then put together a plan based off of our clients' goals and really connect the dots on how to get there on an annual basis. And so some of our clients may only want to be, they may only have a goal of buying one property. So we put together a plan based off of that. Others may be buying 5, 10, 15 properties. And so what we do is lay out a very clearly laid out plan of, based off of where they currently are in their investment journey. It may mean we're doing 3 as conventional financing because they're starting to max out, or we may be doing all DSCR loans. But as we are accumulating real estate and starting to scale up our business, that's where it gets harder and harder, because there are so many unknowns and so many question marks every year when you're going into tax time. And that's what we try to get out of ahead of, and make sure that when you file that tax return, you have a clearly laid out plan before you hit submit. So ultimately the goal is to find that equilibrium point where you're not overpaying in taxes, but still showing enough net income and depreciation to meet your goals for the upcoming year.
Yeah. You basically say you need your accountant to show that you made X amount of money so that you can actually achieve we can get you the financing you need this year. Is that what you're saying?
Yeah. And we can't legally say you need to file X amount. So just to be very clear, but based off of,
it might be a good idea.
Yeah. I want to make sure I'm saying that, but based off of what your accountant is saying is a realistic number that each individual client is filing on their taxes, we can then take whatever is being filed on the return to then back into it and put together a plan based off of whatever is going to be filed on the return.
I mean, that's why it's important to have, again, a lender and an accountant that like understand what you're trying to do, right? I mean, like for our purposes, directly, we basically have a huge loss every single year on our taxes, but that's mainly coming from accelerated depreciation we run on properties, which can be added back and has never prevented us from being able to obtain, financing. But it's just with the right lender, they understand those things, right? And so it's important to be able to work through those. Jeff, I want to talk about just the newer investor that's either buying their first investment property, those that are looking to invest out of state the first time, those that hit that like 10 conventional or 20 if a spouse is doing it with them. Like, these are like some of the common questions. Actually, if you're up for it, kind of impromptu, do a little fire round for you on just like the common questions people we get all the time. So Adam, maybe we didn't prep for this, but maybe we can bounce them back and forth. I mean, these are daily questions that come up, right? So
yep.
One of the most common ones I get is, and I'll pass to Adam, is how do you think about rental income? There's a concern that if I buy a rental property, like, can I count that rental income to offset my debt to income, my DTI ratio? Like, why don't you first define DTI, what it is, and then how rental property is considered in DTI, both initially and over time, to help people continually get loans?
Okay. Yeah. Great question. And it's a good jumping off point. So debt to income ratio, basically what that is we total up all of your minimum monthly payments, including your housing expense, any car payments, credit cards, student loans. I mean, you name it, anything that's reporting on credit. We're not including any type of utilities. So that's not, factored into this. And then we're taking your income. It's a different calculation if you're W-2'd versus self-employed. And I won't get deep in the weeds on that right now, but we're basically going, your total monthly payments versus your income. Most programs have a max debt to income ratio of 50%. The government programs, FHA and VA loans, we can go up higher. Some of the non-conventional products and the jumbo products have a lower threshold due to the increased risk. But that's the quick, easy version of how a debt to income ratio is calculated and what we're looking for. And then in answer to your question regarding the rental income, so it depends ultimately on the program and the type of rent analysis, whether or not we're doing a long-term, mid-term, or short-term rental. And so just a quick example, and this is one of the things that varies by lender because their lenders have their own underwriting overlays. So like if you call some of the bigger banks, they may say, have their own set of rules for their approach for rentals. And especially when it comes to midterm and long-term rentals, they have very tight restrictions typically on those. So for long-term rentals, for instance, we can use at the time of acquisition, at the time of purchase, we can use 75% of the forecasted rent to help you qualify for.
Forecasted. Does that mean even if it's not leased at time of closing?
Absolutely, yeah. So that's basically the way that's calculated is when we order the appraisal, the appraiser comes out and does the initial valuation of the property and then also does a rent survey of the area or rent comparison analysis that's very similar to the appraisal where they're looking at comps on the rental side. And then that number that comes back on the appraisal, we're able to use 75% of that to help you qualify for the purchase.
So that is a huge question that people always get because they assume that I think one, they're assuming either end of the spectrum or they just don't know how that fits in of like, oh, I can count all my rental income and like that will help improve my DTI. Or like, oh, this is all bad debt and I can't. And some lenders probably maybe can't. And I learned that word overlay the hard way with this. Actually, you and I talked about this this last kind of unique property that I was buying that you guys were underwriting for me, where a lot of lenders, I thought, oh, everyone plays by the same rules. They have to underwrite by Fannie Mae and Freddie Mac guidelines, where it's the same. Well, yes, fundamentally, but banks can be even more restrictive on top of that with their internal overlays, right? And that I beat my head against the wall with the overlays that were just so challenging. And so that's really, and that's up to the bank to be as limiting as they want on that. So again, that means it's really, really important to be working with a lender that doesn't have as much restriction. And like you guys, if someone comes in, they can't qualify for a certain loan structure with other lenders, doesn't mean that they can't not get a loan for that property, right? They can't just, it's about working with the right lender that can explore all these different options. So that's why we love working with you guys. But so to be clear, 75% of the rental income can be used to offset the debt. The way I explain it to people, usually without getting like in detail with the math, usually it's a wash your first year. Maybe over time, as rents go up and you have more cash flow, like you can count that as positive income to increase your income. But at least on that initial purchase, like it's kind of a wash, at least on the properties that we see in our network. Meaning if you're buying, if you can qualify with one property, if you have the down payment for 10, you could buy 10 at once because the DTI is not negatively impacting your DTI. That's kind of the way that I look at it. Anything to add to that, Jeff? But
it was a great way to simplify it. Yeah. I mean, especially with the purchase price ranges and the properties that you guys are working on. Yes, you hit the nail on the head with it, where most of the deals that we're looking at, it's having a very minimal impact to our clients' debt to income ratio and buying power. And they have the ability, as long as they have enough capital to buy, for the down payments, they can buy multiple properties. So yeah, that was a great explanation.
All right. Number 2, why would I use a DSCR loan if I still have conventional loan spots available?
It's a great question. So a couple of the considerations, first off, conventional versus DSCR. I'm sure your audience knows. I mean, the DSCR product, that is the commercial loan product that's been around forever, that's been adapted to residential real estate for business purposes only. So for investment properties, and it's a non-conventional product. And so when we're looking at our client situation, question that you asked, whether to go conventional or DSCR, there's a few variables that we look at. So, first off, how close are they to the 10 finance property cap? If they're there, we're going to a DSCR style product or a non-conventional full doc product. If they're close, we also look at, let's say they're a property 6, 7, or 8, starting to hit that level. A lot of times you have to report more income on your tax return in order to get up to those last 2 or 3, which could kick you up into the next tax bracket. So that's another consideration that we loop in accountants on to make sure that, in order to get to those next few, when we're doing planning, what kind of an impact is that going to have from a tax perspective? So that's another consideration where it may make more sense to move over to the DSCR loan, use that money that you would give to the IRS to buy the last 2 or 3 properties to hit the 10 finance property cap and put a larger down payment on a DSCR loan. So those are some of the instances. The other times, if we have experienced investors that just, they have 4, 5, 6 properties, they're at the point where they don't want to provide documentation or they're going for speed. The DSCR loan, the underwrite is much easier. I mean, we're not looking at tax returns, employment, pay stubs, anything like that. I mean, we're literally just a completed application, proof of funds, driver's license, and then an LLC, the LLC docs if we're closing an LLC. So it's a much easier underwrite, a much easier process for the investor. The big consideration with the DSCR loan that is not a consideration on the conventional side are the prepayment penalties. Prepayment penalties. Basically, this is an agreed upon period of time where you're not going to refinance, sell, or pay down the principal by more than 20% or more without having to pay a prepayment penalty that can range into thousands of dollars. And so the way I like to explain this is that there's big pools of money on the secondary market that's lending in this space. And you think, Wall Street, there's pension funds, insurance companies, all the big investment houses are dumping money into this space because they're chasing returns. And they're trying to lock in returns right now where rates are still high. So they're trying to lock people into longer prepayment penalties. And this money that they're lending has a required rate of return already factored into it or already baked into it. So if you're willing to, agree to a 5-year prepayment penalty, you're going to get a lower rate because that required rate of return is being made over a longer period of time. You have the option of buying it out 1 year at a time, and it's usually about 1/8 to 1/4 of a percentage point for every year that you buy out because that required rate of return is getting compressed into a shorter period of time. And so this is one of the things that I always try to get out there and with a megaphone. Any clients, investors that are out there shopping around for DSCR loans, ask about the prepayment penalties because unfortunately in my industry, we have a tendency of just quoting rate and not explaining the details. And if you call 5 different lenders, they're going to give you the 5-year prepayment penalty rate. And if you don't ask about other options, you're not going to see it or they're not going to tell you until you get to the point where you're getting disclosures. So it's just something to keep in mind as investors. Just do your due diligence, ask the questions, especially if you're doing any type of non-conventional investment property loan. because more than likely there are different prepayment penalty period options.
So much I want to cover on this, Jeff. I'm going to try to be brief. I say fire round, and then
We'll have to schedule another one.
Quite opposite. But so okay, prepayment penalty. That's usually step down basis, right? At least a lot of times I see it like your first year. If it's like a 5, 4, 3, 2, 1, your first year you have the highest points. The second year you have step down, and then eventually goes away. In general, like not always the case, but to Jeff's point, that's something that's important in commercial financing, in portfolio loans and DSCR loans. Like you need to be conscious of. And generally speaking, I don't think it's a big issue if you plan to hold your asset. But that's also, Jeff, you brought such a good point. That's also why you should not just be calling up all these lenders asking what their rate is, like, because there's so much more that goes into the rate, especially right now. They're assuming many lenders assume point buy down, which it's like, all right, well, if someone's quoting you a 6% rate and the next lender's quoting you 5.5%, if you're not getting all the details with that 5.5 could cost you thousands of dollars that they're just naturally factoring in, which if you applied that same $1,000 or thousands of dollars to the 6% lender, you probably get a lower rate with buy down, right? So you just got to, again, having a lender that is investor specific, that's transparent, that gives you all the information that can actually guide you, certainly important. And I want to do a quick side-by-side comparison to DSCR, just because a lot of people have heard of these, but they haven't explored them. So generally speaking, when you're comparing conventional DSCR, correct me if I'm wrong here, or add any context, Jeff, but conventional is your 30-year fixed loans, your Fannie Mae, Freddie Mac type of loans. Generally, people want to use those because they can be adjustable rates, but it allows you to have a 30-year amortized and fixed loan at a generally attractive rate with generally attractive fees. Like those are kind of the most attractive to start with for most people, but there's certainly circumstances where you could use DSCR. Generally speaking, DSCR, easier to qualify for, buy them in LLCs. That means partnerships, maybe possibly looking at retirement accounts, things like that. Usually means higher down payment. Fees could vary, rates could vary, usually shorter at their term loans. You usually don't see those as a 30-year term, maybe sometimes, but generally speaking, they're amortized over 30 years and there's a shorter term. But there are certain circumstances where that would make sense. Or if you simply max out your conventional loans or you can't qualify for those, like it's just a piece. It's just another tool in the toolbox, and the lending toolbox to know about to fit into the right time. Is that like a good, quick and dirty summary of those, or anything to add?
It is, yeah. The only thing I would say to add to that is the majority of the DSCR loans that we're doing are 30-year fixed, because the shorter term, there are some options like 5-year ARMs that rates a little bit better, but it's a marginal benefit. And I know there are some lenders out there, especially that are like the true commercial lenders that are doing over 10 units and higher, that are stepping into the residential space. They have these 20-year loans that you've got to refinance every 5 to 10 years. Everything that we're doing on the DSCR side are 30-year fixed, just like the conventional product. So it takes that uncertainty out of it. And then everything else that you said, was spot on. The conventional product, the rates, you can refinance or sell at any point, so you're not locked in. There's never any prepayment penalties. DSCR, they will vary, so you definitely want to see different options based off of what your goals are. So we have some clients that want to refinance or sell quickly, then they're doing 0 or 1 year prepayment penalties and taking a higher rate. We have other ones that are happy with the cash flow analysis at a 5-year prepay and just want to set it and forget it. And those actually are quite a few of your clients coming through rent to retirement, because with these smaller loan amounts, the rate differential to where it's going to make sense to refinance is much larger on a $100,000 or $200,000 loan amount than it is at a $500,000 or $1 million. So it's a consideration too on the loan amount side, where we're going to need a huge shift in rates on these smaller loan amounts for it to make sense to refi. And the likelihood of rates dropping that low probably in the next year or two is relatively slim. I wouldn't count it out there.
Right. Fair enough. And Adam, I didn't actually ask a question, so I'm still going to fill it in.
You didn't ask a new question.
All right. And thank you for the clarity on that, Jeff. Tell us how multifamily, single family, and short-term rentals, so long-term multifamily or single family, how those loans are different, or different qualification criteria, and how you also underwrite short-term rentals. Because I understand you finance all of those options. Just quick and dirty bullet points. What's the difference in those?
We could do a whole recording just on this. The short end is that on the conventional side, it's gotten more challenging to do short-term rentals as of last year. It was the Wild West for quite some time, and the federal government, Fannie and Freddie came out with guidance, I think it was Q3 of last year, where it made it more challenging is the short end. Once you have a short-term rental that you've reported income on a tax return, it's perfectly fine. It's just using short-term rental income at the time of acquisition or the time of purchase is challenging now.
So can you still get conventional loans for short-term rentals? You just can't count
we can. We just have to use the long-term rent on the appraisal now. They will no longer allow a loan to be delivered to Fannie Mae or Freddie Mac with a short-term rental rent survey on the appraisal, which we were doing plenty of for years.
And then multifamily is 25% down, usually conventional. Single family 20% down. Anything else to be aware of between all those? Short term would be, if it's single family, would still be 20% down potentially, or unless
we have an option for 15. So I mean, again, on the short term rentals, we can do a 10% down vacation home loan or a 15% down investment property loan, which is the true investment option. You can do those on long term, short term, or midterm rentals, but we have to use the long term rent analysis on the conventional side. But there are non conventional products that mirror it. Basically, we have a 15.
I'm sorry to interrupt. I wanted to ask about the DSCR typical down payment. I forgot to ask about that. What is that? Just so we have that number.
Great question. So we have a 15% down product that just started coming back. It disappeared after March 2022 when rates started shooting up, and it came back in the last 6 to 9 months. 1 to 4 units, DSCR of 1 or above. The rates are not great right now. They were better in the summer, and we were doing quite a few of them. Now it's gotten more challenging. But most of the properties that we're looking at are a minimum of 20% down. Anything short-term or midterm related, minimum of 20% down. And that's just the general rule of thumb right now.
All right. So let's go we're in a very weird rate environment where usually whenever you look at conventional versus DSCR, you think 0.75% to 1% difference. That's kind of been the rough number over the last many years. Right now, there's not much of a difference, is there? I mean, they're pretty much on par with each other whenever I've looked at the DSCR versus conventional. Is that what y'all are seeing as well? And what on earth is happening that, in your opinion, that's causing this?
Yeah, so what's been interesting is that the DSCR financing, if you're willing to take a longer prepayment penalty and put a larger down payment down around 25% or so, those rates are actually better than conventional rates. And we saw them back in the summertime dip down into the 5s, which for a short period of time, which was incredible. So it's just goes to show how much money is being dumped into the secondary market when it comes to non-conventional financing. A lot of the big investment houses have been getting into it. Their risk tolerances have been going up. And as a result, because there's so much money that's coming into that space, rates have been coming down due to all the competition. So that's been the big seismic shift and why those rates have been more attractive. If you're looking for a shorter prepayment penalty, the rates are going to be better on the conventional financing right now. So just to kind of put that into perspective, and I know we're recording this on February 28th, and as of right now, rates have been coming down. So we've had a good decrease in rates over the last few weeks. We had an inflation reading come out today that was right in line, which helped a little bit. So we'll see where things go from here, but rates are trending in the right direction again, which is nice.
Jeff, as we kind of wrap up here, I know that you have some specific incentives for the rent retirement community, which we want to hear about. We certainly appreciate you working with us on. But I want to get just you work with a lot of real estate investors, the whole spectrum of brand new investor, out of state investors, working with a lot of our clients, of course. You work with very sophisticated, high level investors doing some more creative financing options, like on the DSCR side. But what advice, or where do you see the newer investor go wrong where they can't qualify? I mean, just give us maybe a quick run through like the newer investor, the first time investor that you work with. What are some main like obstacles you have to overcome or pieces of advice you have for someone to like get their ducks in a row to be able to qualify for the best financing options for that first few properties? That's
a great question. I mean, it's the first door is always the hardest, just making that leap. And I mean, honestly, just picking up the phone and having the conversation is usually the hardest part, and getting the ball rolling. And the best advice I can give is get the conversation started as early as possible, because there's usually always a way to get there. And so most, first-time home buyers or investor curious clients that are, want to get started, they see everybody buying properties but don't know where to start. the earlier you can start, have that question have that conversation and start asking questions and really take the mentality of there's no stupid questions. I mean, just ask every question you possibly can get involved, listen to podcasts and get online. And there's so much great information out there on how to get started in real estate investing. And from a lender perspective, I mean, don't ever feel like you're wasting your time or, it's too early. You may not be ready. We'll help you put together a plan. We'll have the conversation, see where you are right now. Most clients are pleasantly surprised to see that they can qualify, and it may not be as difficult as they thought in their minds. So just, again, I mean, that first conversation is the most important, just to get the ball rolling and start creating some momentum. And if worst case, it doesn't work out now, there are solutions. Like, there are many solutions that we present to our clients, potentially, gift funds or a cosigner, things along those lines that can bridge the gap to get you into a home sooner, with the goal of, eventually refinancing, potentially getting that cosigner off, or, just, again, getting your first property going and then starting to build from there.
Yeah, it's all about having the conversation. So often we hear people are like, well, I don't know if I can qualify for this, or I haven't. We only know unless we ask the lender, right? You got to apply.
Yeah.
And then if they say no, like, okay, that's great. Now we have some objective things that we need to fix, or maybe there's another lender, another lending solution that might work for you, but you got to get that feedback, right?
Yeah. And we only do a soft credit check at this point. I mean, that's another big hurdle. People don't want their credit pulled. So we only do a single bureau soft pull. It's not a very lengthy list of documents that we need. So it's a lot easier than you think.
That is crucial, that the soft pull piece, because, and I would argue that a hard pull doesn't matter actually in the big picture. A lot of people are like, oh, I don't want to affect my perfect credit. Well, it's like, well, if you're over 740 credit, there's no real benefit. Credit is meant to be used, and you don't get I could go on my whole tangent, but the soft pull just alleviates that conversation.
Yeah.
I know Adam's chomping at the bit for a couple more questions, but I'm going to sneak one more in, Jeff. What's your advice to someone sitting on the sideline right now saying, rates are still high? And I would expand this beyond just the lending hat you're wearing, but more so the investor hat. I have my own opinion of now's an excellent buying opportunity because of where rates are at, and now's when you want to buy. But what's your advice to someone that's kind of been dragging their feet over the past couple of years and not sure they want to get into real estate, but they haven't yet?
Yeah, I mean, a lot of people have been waiting for rates to come down, and honestly, I thought rates were going to be a bit lower at this point, and I think most of us did. I mean, it's just, unfortunately, inflation has been far stickier than we all anticipated, and these rates are sticking around. These higher rates are sticking around a lot longer than we'd like. So, I think the bottom line with it is that, once rates do come down, we have so many people sitting on the sidelines right now. I mean, if you can think back to, prior to when rates went up, we had so many people pre-approved at 3, 4, 5% that can't qualify at 7% or 8%. And they're stuck on the sidelines. And so what we've seen is that every time rates dip, and we saw it again last summer, we saw it in January of 23, when rates dipped down into the sixes, we saw demand spike because more and more people are able to qualify, and they started jumping back in. And then we saw purchase prices starting to tick up again. And so it's been an interesting balance. And really where the inflection point that we see coming is once rates convincingly get back down to the high fives, low sixes, and it really starts hitting the news that rates are at those levels again, we're going to see the demand side pick up. I mean, there's going to be a lot of people jumping back in, and there's no inventory. I mean, we have such an inventory shortage in this country that, I mean, the last report I saw, we're somewhere around, I think, 4 or 5 million homes short, and it's going to take years to build our way out of this. So it's just, and answer your question, it's trading one problem for another. Yes, rates are high. It's hard to get deals to, pencil out and make the math right now, but it's not going to get any easier once rates do eventually come down, because you're going to be competing against a lot more people. It's going to be pushing property values up, and yes, rates are going to be lower, but it's going to be much harder to get into contract, and property values should, in theory, continue to go up because of supply and demand.
Well, you can always refinance, right? And that's always just a data point, and interest rate is a point in time. But really, where you can be successful in real estate is buying at the right time, where you can ride the appreciation wave up, right? Yep. So, anyways, I think that was a really sophisticated answer on timing the market and from a lending perspective. Thanks for sharing that. Real quick before I forget, since we're talking about refinancing, what are your benefits for rent to retirement investors? You have, I think, some incentives because there's a potential to refi in the near future. What are some and beyond just offering the whole gamut of loan options and just being an excellent strategic planner for investors building a business, what are some things specifically for the rent to retirement community BluPrint is offering?
Yeah, we have a $250 Amazon gift card right now. That's the first special that we're running with you guys. I know we're talking about some other things too that we'll be rolling out soon. And then in regards to your question on the the refinance side, so the short answer with this is that when rates do come down, we are always looking for opportunities to refinance and to help our clients lower their monthly payment. But we are also looking at trying to keep the cost down as low as possible, because the question I always get is, how much is it going to cost to refinance? And it can be thousands of dollars. And so what we do is we offer repeat pricing to all of our repeat clients, and then you can apply that credit toward your closing costs. And really, the period of time I like to use as the example is 2016 through 2019, when rates had come up to about 5.5, which we thought were quite high at the time. Had no idea what was coming. And then when rates started coming down in 2020, we would refinance our clients on a no closing cost loan or a very low cost loan every time they were saving about $100 to $150 a month. That way you could take advantage of the lower rates as they were dropping without having to tack on $3,000 worth of closing costs each time. And then eventually, once we got down to the bottom and rates were down in the threes and even high twos, the way people got rates that were at 2% or even the occasional one is they were buying, doing one last refinance, paying a point or two to buy the rate down, and then never touching the loan again.
Yeah. So I want to harken back to a little while back. I always tell people when they're on the phone with rent to retirement and asking about financing, I'm like, well, you already took the time and are serious enough that you booked a call with us. If you're willing to book a call with me, you should be willing to book a call with a lender to talk that way. I mean, it's only, you're obviously serious enough that you want to talk to us. You may as well talk to the person who's actually going to be giving you the money. So is that $150 a month thing? Because one of the questions I do get is, when does it make sense to refi? So can you tell a little bit about, there's a $150 a month thing you kind of mentioned. Is that the marker you're kind of looking at? And then when is it worth it to refi if you're pulling cash out? And y'all dependent, whenever you count in the fees and everything else, when does it make sense if you're pulling cash out?
It's a great question. So let me start with the first part. So 100, 150 a month, is usually the target without having to tack on, thousands of dollars in closing costs or, do a rate buy down as rates are coming down. So with that being said, it depends on ultimately what the loan amount is, what that rate differential needs to be. So on a larger loan amount, that may only mean a quarter or a 3/8 reduction to the interest rate. On smaller loan amounts, it may mean a full point or a 1.5. So it a little bit of a sliding scale. There's no, one size fits all on that side. It just, again, depends on how much you owe and where your rate currently is and how long you've been in that loan. Because that's the other consideration, that if you've been in the loan for 10 or 15 years, if you do another 30-year fixed, you're resetting that loan and you're going to be paying a lot of interest again on the front end, because all mortgages and loans are front end loaded with interest. So every payment that you make, a little bit goes toward principal, most goes toward interest, and then it slowly shifts as you continue to make your payments. So that's a consideration that you need to keep in mind when you're refinancing. And then regarding the cash out refinance option, so right now with these higher rates, especially with people with such low rates to begin with, people that are in the 2s and 3s and 4s, I recommend not touching those loans if at all possible, because we're probably not ever going to see rates get that low again. So what we do is we typically look at home equity lines of credit first, because even though the rates are a little bit higher, the overall cost of those are a lot lower than doing a refinance, and you don't have to touch your first mortgage. And so that's going to be the first approach, whether it's a primary residence, second home, or investment properties. HELOCs are available on all three. I won't get too deep in the weeds, but there are some restrictions on the investment side that are not applicable to the primary residence side. And then if, let's say, we have clients that are in a position where they can't qualify for a home equity line because the credit score requirements are higher and they're in a position where they need to take the cash out, then that's when we typically will do a cash out refinance, either to pay off debt or to take that money and apply it to the next purchase. But the default is always to go to the home equity line first and the cash out refinance second in this current market. Later down the road, when we're refinancing all of these loans and the higher, they have higher rates, that won't really be a consideration. But it's unique to this market.
All right.
Questions on that?
No, that was a good answer there. So why don't we have a time for people to go and book calls with you. Obviously they can come to us and book a time to talk with us, and then we'll happily introduce them to you to get it there. But what would as you go through it, what's the most important question people forget to ask their lender in the first call that they then call back and is like, oh my gosh, I should have asked you this in the first time?
That is a great question, Adam. That is the first time I have been asked that question.
Try.
Great question.
I'm going to pop in while you're thinking about it, Jeff, and say, quit asking about rates. That's the first thing you should not ask the lender, right? Or ask at least about rates and fees. But
we've trained all of our clients and the home buyers and investors out there to do that. That's more of my industry's fault than anybody else's. But it is, obviously it's a consideration. It's the question everybody wants to know. The most important thing that everybody should do in answer to your question, Adam, is get everything in writing. So you want to make sure that you're getting rate options. Ask for options. If they're only giving you one product, like a conventional, and maybe not showing you a DSCR or even talking to you about it, ask about it. Make sure that they have that product mix. And then make sure you're getting multiple options, rate options. You want to know what the cost structure is for each rate. And again, for prepayment penalties, and then get a corresponding loan estimate so you can see, what the lender costs are and get a breakdown of everything. And then just know that when we're in a market like this, especially when, it's this competitive, lenders get creative with their itemizations. They may trim things back and get a little tricky with it. So just know that when you're comparing them, have the conversation, the deeper conversation. Is there any other fees that are going to be associated with this? Is there anything that could possibly change? Because as lenders, we don't have the ability to, choose the title company or escrow company. So these are the things that can fluctuate depending on the title company and those kinds of things. But when it comes to, origination points, when it comes to processing fees, underwriting fees, those types of things, those are things that we do have control over as the lender.
Should the expectation be, Jeff, that lenders give that to you before filling out an application? Or after?
We typically will give rate options. It depends. I mean, the reality is anything that we're going to provide on the front end isn't going to be really worth the paper that it's written on until we get everything put together anyways. But a lot of clients will want to see pricing before they go further, which we do all the time. So, on the initial call, we'll go over pricing based off of the metrics that they give us, their credit score, the property type, purchase price, down payment, that kind of stuff, to give them a jumping off point with it. And then we have a little spreadsheet that we use where we give multiple options that shows the points associated with it. And that's typically what we'll use as a kind of an intro to show what the options are as they're running numbers.
So people don't need to, yes, the lender needs all the full application to give you a true estimate because, interest rates vary daily, your credit score and things like that, the loan amount, down payment, like that will affect the rates and things like that. But generally you can get a quote up front. That should be very quick. Yeah. And then I think another point is that people don't need to have a property under contract. Like they should, at least following our process. And I think in general, you start getting your loan quotes early, right? Like that's the first conversation you should have probably outside of our team, is getting a quote from a lender and starting that conversation. That way, if there are things that you need to address, you have time to do that. But ultimately, it's also time consuming, filling out information, and you need to know what you can qualify for. So it's really about amount. I don't know if you have anything to add to this, Jeff, but like for us, it's not about like, okay, if you want to buy, it doesn't really matter where you want to buy. Make sure a lender can land in all the areas you want to buy first and foremost. But other than that, it's like, all right, if you got, I kind of tell people like reverse engineer. If you have $60K to invest, then, you can reverse engineer that and say, well, that's 20% of a $300,000 property, so tell the lender you're going to buy a $300,000 property. If they need an arbitrary address, like we can give them that can always be changed. Like you don't have to have the property in front of you. you should have the lending figured out before you identify the property and go under contract. Would you agree with that?
Of course, yeah. And so with the quote, and I will add to that, the quote, we don't need a full application or anything like that. We can go off of whatever the client provides. For the pre-approval, before you're going to be able to submit an offer on a property, we do need a full application. We have to check income, assets, because we're basically putting our reputation on the line when we issue that pre-approval letter. And so we take that very seriously. So that is the consideration there. And then what you were asking too about the down payment, or you mentioned about the down payment. So if somebody knows they have $60,000 or $100,000, you talk to your loan originator or your lender about this, and they'll be able to back into that and then say, based off of how much you have, this is what you would qualify for based off of your credit score and property type. And so you don't need to figure that all out on your own. I mean, that'll be done, on the initial conversations based off of, what the information that you give us.
Yeah, I've gotten approved for several properties located at TBD.
Yeah.
On my pre-approvals. I wanted to ask one more quick question before we wrap up, and there was something that you said that made me think about it. A lot of people come back to us when they get their initial loan estimates and absolutely freak out about the amount that it says they might need cash to close. And talk to people a little bit about why that number isn't nearly as important as what they think it's going to be in that initial loan estimate.
That's a great question. So there's things like when you look at the estimate, everybody goes straight to the bottom line number without actually looking at the breakdown of everything, and then think that number, whatever the settlement charges is the closing costs. Most times when you look at it, you have, an impound account that you're setting up for your taxes and your insurance. You're skipping a payment, it's being made. So like if you're funding a loan this month, mid-month, you're not going to have a payment that first month or the second month. That payment will be due the first of the following month, but that interest is all included in that estimate. So that's a number in totality that will inevitably change depending on, how much the title company is charging once we get the accurate fees once you're in contract. So, ask the questions before I love how you said, Adam, that people tend to freak out and overreact to it. Slow down, realize that these things will change, and ask the questions of why these numbers seem a little higher than you were anticipating. Because, if you have, like in Zach's example, $60,000 to put down, that isn't all going to go to a down payment. A portion of that will be going toward the down payment. And then we need to make sure we're leaving enough of a buffer, depending on the purchase price of, $10,000 or so for the closing costs and your impound account, your insurance policy that needs to be paid in full for the full year. So those types of things that are all included in that bottom line number that most people don't slow down long enough to actually take a look and see it actually breaks down.
Yep, and they're never estimated on the low end. I'll put it that way. Nearly every single time, whenever you get the closing table, you look and you're like, oh, well, that number came down 20%.
Well, at the beginning, on the initial disclosures, you don't have the insurance policy. You're estimating that. You may not know the taxes of the property. I think there's an algorithm you use for that. So it's like very often the initial disclosures, people are like, oh, holy cow, to Adam's point, it's so high. And it's like, well, then that's how you just got to go through further due diligence, get your actual insurance quote, like adjust the premium as you need. More often than not, it's always lower. And then, look at what actually taxes are at for that year. If it's new construction, taxes may be a fraction of what they will be in 2 or 3 years, but but you're still estimating for that. You may not even have to escrow your tax and insurance if you don't want to, right? I mean, we don't have time to cover that today, but if you want to pay those on your own, because you're paying them kind of a year in advance, like if you have 10 properties and you're escrowing $30,000 to $5,000 per year, like that's a lot of capital that you could probably reinvest and just pay that when they're due. Anyways, more things, just get on the call with Jeff and walk through this, right? And his team.
Yep. So the link to schedule a call with BluPrint will be in the show notes. Jeff, I really want to thank you for joining us today. Again, Jeff is the VP of Investor Lending at BluPrint Home Loans. You can also check out all the properties that you're going to want to get pre-approved for over at renttoretirement.com. That's renttoretirement.com. You can schedule a time to talk with us, and we will introduce you to Jeff if you don't want to click on that link that's down in the show notes. I really appreciate the time y'all spent educating yourselves today. We'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.